Joining us now, Jerome Schneider, PIMCO head of short-term portfolio management, here with us in the studio. Thanks for being here.
Hey, good afternoon.
So when we, obviously we obsess over Fed speak. It's what we do as people who watch the markets, right? But the Fed itself says we're watching the data. So does that mean we should sort of put the commentary to the side and also watch the data?
Yeah, the commentary from the individual Fed speakers can be elusive at times. And what we're thinking about in this current environment is sort of the intersection of data that comes forward from growth, data which comes from inflation, and really that prescription was made clear today by the Fed minutes, where they're going to sort of take a pause, see where the economy evolves, and more importantly, what happens to the monetary policy in the medium term. So individual comments, while important to sort of get a flavor for the ingredients that the Fed's considering, won't necessarily lead to an output. It won't necessarily be a baked cake in the near term. We need to be thinking about where the Fed's going to do, and quite clearly they're going to be relying upon the optionality of simply having a Fed statement, having Fed minutes, which gives them that optionality over that medium term.
Right, and effectively what they're saying is they don't know what effect all of the fiscal policy coming down the pike is going to have on inflation. And so if they're waiting, we kind of have to wait on that front as well.
Investors, the Fed, a lot of participants would like a crystal ball to say, here's where the destination is. And quite honestly, it might take some time for us to get to that destination. The reality is that fiscal policy is something that's going to be contended with in the short term. We're clearly seeing the administration go after some areas in that regard. But longer term, we're still waiting to see the effects on the fiscal outlook longer term. And there's going to be some points of interest on this in several regards. Number one, the fiscal policy with regard to revenue increasing. Tariffs obviously is an income to that balance sheet. On the second hand, if it comes into consideration later on this year, tax cuts obviously a negative. And how it all comes to fruition, the timing may not exactly be so prescriptive, so precise that we'll simply say the Fed's going to need to ease or perhaps even raise rates in the future should inflation be stickier. So for investors, we find ourselves at a very unique point in time. Risk assets are nearly priced for perfection, especially when you look at equity risk premiums. Second thing to look at is if you look at the forward rate expectations, the dividend expectations for equities, for the first time in a few years, they're actually lower than bond yields. And that puts us in a very interesting environment where perhaps taking additional risk in the form of equity spreads, credit spreads, things like this may not necessarily be as incrementally beneficial to portfolios. It might actually bring more volatility to portfolios. So it's just something to consider as this outlook, and more importantly, as the Fed continues to be on this glide path for a while, that we need to be considering as investors in terms of our portfolio construction, focusing on a little bit less volatility that could potentially be emanating from your portfolios.
So that's one potential tactic. But I'm interested in your purview as short term.
Sure.
Because as we've been talking about and sort of gesturing at, short term is really tricky right now. I don't envy you trying to figure that. I mean, first of all, how do you define short term? And what do you do short term given that there is so much uncertainty?
For PIMCO, we think about short term as capital preservation. Think of the yield curve as the 0 to 5 year space. So that's relatively short in bond terms. But what's interesting about the current environment is that the short-term environment, rates have gone up over the past few years, but they're now peaking and coming down. From a personal and individual perspective, and even if you're a corporation, there's a unique stratification going on within the rates you can earn in cash now. We've seen, if you go look at your sweep accounts and your individual investment accounts, they could be as low as 5 basis points, close to 0%. And other places with savings deposits, you'll find yourself in the situation that you're not earning near the Fed funds rate of 4.25%, it could be 2 to 3%. So simply staying invested in how you manage your cash and focusing on that is incredibly important to performance these days. So as people still continue to seek safety in this environment, we want to be very cognizant of how they're doing so. And bond yields as a whole can do that. Having some interest rate exposure helps to prevent that left tail risk and create some capital appreciation in owning bonds. But if you're simply going to take the alternative and it be in that wait and see crowd, you might want to see and focus on how you're putting that cash to work.
Not all cash is created equal. And then finally, I want to ask you about international exposure, because on the equity side, we've been having a lot of conversations with people who are looking outside of the US for the first time in a while.
Right.
Is that happening on the fixed income side as well?
It's a very unique environment. And what we're finding ourselves is now that we're past the global financial crisis many years ago, and we're finding ourselves past the COVID crisis, the policy responses from monetary policy entities around the world are very different. So what that ultimately means for investors is there's a divergence in interest rate policies, whether you're looking at the Bank of England, the European ECB. the Australian central banks, these are all central banks that are being much more active in cutting rates than the United States. And as a bond investor with a global outlook, that's creating unique opportunities for relative value trade, something we haven't seen in quite a while. But again, for an investor focused on their portfolio, focused on safety, simply focusing on savings accounts, where those are, and more importantly, optimizing into a shorter bond portfolio can be worth a couple hundred basis points or percentages to their investment. So there are some good places to hide out, and the safety is your concern. Finding some income in bonds is definitely a place to be, at least for the near term, until we get some clarity in terms of the economy and growth.
Jerome, as a bond guy, I expect bond guys to be pretty pessimistic. You don't sound very pessimistic, but I am curious what the biggest risk that you're watching out for is.
Yeah, without a doubt, one of the things that we're finding is that, let's contextualize the conversation here. Growth is still 2% right now. It could be on the upside if certain things happen. It could be on the downside also at the same time. And unless you have a very bullish view and that crystal ball says green, the reality is that that outlook is a little bit more clouded. From that perspective, the euphoria that we had in the fourth quarter last year with growth has come off the boil a little bit. Yeah. So don't take me as a bond bear or a negative person, but we are simply saying there's probably a little bit more volatility out there than the average market participant is suspecting. And in that means simply, let's embrace a portfolio that's a little more diversified at this point in time. And when you put that into context, earning yields and returns of 5 to 7% isn't an outlandish assumption for having some fixed income in your portfolio. That might be very different than having a high-tech stock portfolio, obviously, but that's the context we're thinking about right now, given the outlook, given how policy is going to be evolving, and more importantly, given the uncertainties not just with regard to monetary policy, but also geopolitics. There's a lot of factors out there. So we are cautiously optimistic on the economy. We do think that there's potential for additional rate cuts from the Federal Reserve this year, but the reality is that that's probably evenly balanced, and that outlook could be moved in one direction or another pretty easily over the next 6 months. So for the time being, we need to be focusing on that portfolio construction and that income generation.
Gotcha. Jerome, thank you so much for coming
Great
in.
to be
Really
here.
appreciate it.